heard. This time, if we can get a safety briefing from Ted Phillips.
Thank you, Chair Stein. Safety is a core value here at JEA. For those attending the meeting in person, the safety protocol is displayed on the screen and in your materials. For those of you attending virtually, please be mindful of your surroundings. Thank you.
Comments from the public?
Mr. Chair, Bobby, we don't have any speaker cards. I think we can move forward.
Okay. At this time, the fiscal year 2024 external audit plan from John, Talia.
Yeah, this is John DeSanto for the record. I am the partner in charge of your audit. Natalia, unfortunately, will not be here today, so I'll be the sole person from Ernst & Young presenting your 2024 audit plan. Chair Stein and members of the committee and members of management and the board, I'm happy to be here to present your audit plan. From an executive summary standpoint, I'll start on the left and then move over to the right. As far as what's new and next, these are the new accounting standards. There's 3 of them that are required to be implemented for the 2024 fiscal year. None of these are expected to have an impact on JEA's financial statements. The first one, GASB Statement 99, that just cleaned up some prior GASB statements and made some clarifications and clarifying language in the statements. None of those areas, though, impact JEA or their financial statements. GASB Statement 100 deals with accounting changes and error corrections. I know since the time I've been here, which is about 7 or 8 years, JEA has never had an error correction. But from an accounting change perspective, that also includes when new accounting standards are being implemented. And again, JEA has always been doing what the new standard actually requires. Again, there was diversity in practice, so this standard kind of just takes that diversity that existed in practice and now requires it to be accounted for in a specific way. And again, JEA has always been accounting for it that way. Same thing with Statement 101 on compensated absences. That's the accrued vacation and sick pay. JEA has always accounted for it as the new standard requires. Again, there was diversity in practice, and this standard now requires it to be handled and accounted for in a specific manner, as JEA has always been doing it. As far as actions the team's taking, that would be our team in the next 90 days. This audit plan communication was created a few months ago. The first item on here, we have issued your uniform guidance audit for the FEMA program for 2023. That was issued in June, actually, and we had a clean or an unmodified opinion on compliance with that program with no findings. And the second bullet there, we are currently in the process of doing our planning and some of our pre-work reviewing and analyzing your internal controls and things like that. We're in the process of doing that and completing it now. Moving to the middle, the 2024 audit plan, as I mentioned, the June to August timeframe is always when we're doing our planning of your audit and our interim procedures, again, reviewing your internal controls and things of that nature. Year end, we're scheduled for October through December, again, consistent with prior years. The other items on here, I'm going to go through in the slide deck a little bit later on. The post-report procedures, January through March, after we complete our audit of your financial statements, the Florida Department of Environmental Protection requires certain procedures to be performed by auditors and a report to be issued regarding storage tanks and the tangible net worth and things of that nature. to make sure that JEA has sufficient resources to address those environmental things. Again, we've always issued those reports, usually in the February timeframe, and that's why this is on here. Additional points to consider on the far right, future GASB pronouncements, Statement 102, and these statements are both required to be implemented in your next fiscal year. Statement 102 on certain risk disclosures. That standard, again, will require for areas of risk for additional disclosures to be made. Not very much will change in your footnote disclosures. JEA has always done a really good job disclosing any contingent liabilities and things of that nature. Again, this is another thing where there had been a diversity in practice, and the GASB's trying to tighten that up. So again, no real issues there. GASB Statement 103 on the financial reporting model improvements. And if you think of the reporting model, that's your financial statements. That's the actual report. And it had been about 25 years since the GASB last looked at that reporting model. And based on feedback they've received from both users and companies preparing financial statements, they're just requiring a number of clarifications and updates to the reporting model. In reviewing that standard, the only significant thing that would impact JEA would be what's disclosed in your management discussion and analysis that goes in the front of the financial statements. It does require a lot more description of some of the significant changes from the prior year to the current year. And really with a focus, I'll say, on the business reasons for some of those changes as opposed to just describing mathematical type changes. So just to give you an example, let's say revenues went up $100 million. Sometimes the explanations have been that's because we had 50 million increase in electric and 20 million in this and 10 million in this, without explaining, well, why did the electric go up 50 million? What's the business reason behind that? So the update to this reporting model actually requires a lot more descriptive analysis explaining the business rationale for those changes as opposed to just some of the components, if you will, of the change. Again, those are effective next fiscal year, fiscal 25. Areas of emphasis. These are the significant areas that we focus on during the audit. They're on this list for a couple of reasons. One, either the balances are very material. Two, either they're significant to your operations like revenues. Three, the computation of the balances involves estimates made by management or significant assumptions being used by management. Or the last thing, there's just an increased risk due to maybe poor accounting controls or things like that, which has never been the case here at JEA, but that would be a reason why something would be on here. I'll tell you that all these areas are consistent with the previous year's audits. I did, however, want to focus on this slide here, the very last item, the risk of management override of controls. And I always like to expand a little bit on this. And you see that the significance of that risk is high and it's high subjectivity. That's on there because management in their position, they have the ability to influence accounting and they have the ability to exert influence over the accounting, the recording of adjustments, et cetera, just because of their position in the organization. So that is a risk and a significant risk that in an area that we always look on. So you might say, okay, well, Ernst & Young, how do you address that risk to make sure that we don't have any issues there, any improprieties or anything like that? We look at a lot of journal entries. And in looking at those journal entries, we're looking at who prepares the journal entries, right? If Ted over here is preparing some journal entries, that's unusual, right? Ted's not a person that would prepare journal entries. So we actually get a data dump of all of your journal entries for the year, and we're able to create these filters. Who's preparing them? What days of the week? There are a lot of journal entries being prepared, let's say on Saturdays and Sundays. And again, who's preparing them? Are they people that would normally prepare those adjustments? We're also looking for unusual amounts, like even amounts, like 10 million even, or 999,999. So that's another filter that we'll do on them. And then we're looking for things like, are there journal entries being made to accounts like a normal debit account, like a fixed asset account or a capital asset account? And is there a large credit entry going to this account? And that could be indicative of a fraud or something being covered up. So we do a lot of work around there. In addition to that, we do look at significant unusual type transactions, making sure that there's a business purpose and looking at the business rationale for those transactions. We're looking and reading through board minutes because that's where we're going to find out about any significant new contracts or new transactions and things like that. Again, making sure we're comfortable with the business rationale. So that's why that's on here. It's been on here in the past, but I always like to just step back and emphasize that one, especially to the committee. But, that is how, from an audit perspective, we cover that risk to make sure that there are no improprieties there. And as you know, Ernst & Young's been doing your audit for a number of years, and we've never found any instance of impropriety whatsoever. But we still are required to say, yeah, there's a risk of that, and we need to address that risk. I already talked about the GASB pronouncements, so I don't need to focus on that again. Involvement of internal auditors. As you know, under the terms of our contract, we receive 400 hours of support from your internal audit department. And what that does is that actually saves you about $40,000 plus on your audit fees. These are the areas that we use the internal auditors, or we're planning on using the internal auditors for. So they help us with all these things, purchases and payables. They do some work there. They do some work around the regulatory accounts, officer expense testing, derivatives and swaps, other expenses, fixed assets, some accruals and things of that nature. When we use your internal auditors, they're under the direction of Ernst & Young. So in other words, we give them audit programs. We tell them what areas that they're going to be working on. We tell them what procedures they need to perform. And then Ernst & Young reviews their work. And we also re-perform their work on a test basis. So let's say they sampled 50 capital asset additions. We may pick 5 of those same and make sure that we agree with the conclusions reached by the internal auditors so that we have a basis for relying on their work. So again, these are the areas that they'll be working on to support your 2024 audit. Appendix A, these are the required communications, as you know, and I've explained during all of your planning and also the audit results discussions. Auditing standards require external auditors to communicate to those charged with governance in organizations like this particular committee, as well as the board of directors. Certain matters related to the audit. These communications are the planning communications. And then when we get to the audit results, I'll have another set of communications that you're probably all familiar with that I'll be communicating to you. So real quickly, as far as the terms of the audit agreement, including the objective of the audit, what's the auditor's responsibilities, what's management responsibilities, et cetera, those are depicted in our audit engagement letter. Management does have a copy of that engagement letter. Certainly, I can provide you with a copy as well. So if anybody on the committee would like to see that engagement letter, you can reach out to Russell, Ted, or their team, or you could reach out to me, and I'll be happy to provide you with a copy of that engagement agreement. As far as the planned scope and timing of the audit, I've already covered that. The significant risks, I had gone over. Those were the areas of emphasis that I had gone over. With respect to independence, Ernst & Young is independent in both fact and appearance from JEA, and there are no transactions or anything else that would impact or bear upon our independence to focus as your external or independent auditors. And then during the course of performing our audit, we will be making inquiries of this committee, executive management, as well as others in your organization. We do cover those during the course of the audit. And we're asking about the understanding of the risks of misstatement, if they're aware of any fraud, any violations of laws or regulations, or things like that. We typically don't do those inquiries in a public meeting like this. So again, our team will be looking with your team to set up some times so we could make those inquiries of most of you that are in this room today. And that concludes my presentation. With that, I'll just open it up for any questions that anybody has related to our 2024 audit plan.
Just a quick question. Is there anything that this committee should be asking you that we have not?
I don't think so. Your committee's always been pretty active. I will say at the latter point of the agenda today, there is an executive session without members of management present. So if there ever is anything that is, confidential or of importance that's not for the members of management to hear, we usually will discuss it during that executive session. I can tell you historically, we've never had anything really significant. I think the most significant thing we've talked about in the past has been around succession planning for the key executive positions in the organization. But from an accounting, a control standpoint, there's nothing that you should be asking me that you haven't.
Okay, thank you.
John, thank you for your presentation, and stepping back, now we have a physical quorum, so I want to go ahead and get an adoption of the agenda and adoption of minutes. Is there
So moved.
Second.
any discussion? All those in favor, aye.
Aye.
The motion passes. Thank you, guys. Now can we get Lee to go through the internal audit update? And MG, for your benefit, John has been he's been very open and very communicative to all the people on the audit committee. So any questions you might have, he's been very open to the details of any question you might have. With that, I'll hand it to Lee.
Good morning, Chair, Board, and committee members. My name is Lee Montanez. I am the Director of Internal Audits. First, I wanted to give you an update of our audit plan status. Since our last meeting back in February, the internal audit team has completed 9 audits or consulting engagements. Those are listed in the box, the left-hand corner, and are bolded. I did want to point out that some of these are management requests, such as the Maritime Transportation Security Act Facility Plan Review. The audit staff invested around 25 hours to complete this and saved JA around $3,000 to $4,000. And then the landscape contract and service assessment was requested by our facilities team. On the right-hand corner, we have in-process audits and engagements. Most of these will be completed within 30 to 45 days. So everything that has an A to it, it's an audit. Everything with a C, it's a consulting engagement. We do have upcoming audits and engagements that we'll review, and some of them have been either canceled or postponed for our next year. Highlighting some of the audits, I wanted to bring to your attention the sales tax audit, where we found it to be rated as a needs improvement. There were opportunities for improvement around contract writing related to sales tax exemptions and how sales tax are managed here at JA. On the other hand, I did want to mention that we completed a capital and operating budgets, which was rated outstanding, which means that the audit staff did not find any observations or any issues with that area. So congratulations to the capital and operating budgets team. Finally, the landscaping contract and service assessment, we found many issues related to contracts and how these are administered here at JEA. Next slide is our open and closed audit report issues. So year to date, we have 29 open action plans. We meet with the business on a quarterly basis to get updates on these plans, and all of these are on track. So far for fiscal year 24, we've closed 7 action plans. Those are listed, and as they are rated, they're noted here in this chart. We want to bring to your attention 2 of these action plans. One is related to the fiber network resiliency and water wastewater management. Key changes were made in both areas to improve how projects are selected and worked on, including how redundancy for the fiber network. There are two major initiatives we're currently working on. One is the fiscal year 25 audit plan process. This is key in creating our audit plan for fiscal year 25, which I will be presenting during our next meeting. At this point, we've sent out surveys to management. 90% of those have been completed. We started conversations with leadership, and we are starting to gather this information and starting to narrow down which areas are of concern and higher risks for us to audit. Finally, our next major endeavor during the summer is our quality assurance review. So quality assurance review per the IIA and per standard 1312, we are to conduct an assessment every 5 years. We have engaged Honkkamp Kruger, who is working on that assessment right now, and they are the firm that worked on our previous QAR. So we are hoping that by next meeting, we'll have the results of that quality assessment to discuss with the committee. At this point, this concludes my presentation. I'll take any questions. Thank you.
Good morning. On the item rated as needs improvement related to sales tax, it sounds like there may be some revenue opportunities there. Does the staff submit remediation plans to you? And if so, have they been, and are you satisfied with those?
They have submitted remediation plans. Some of them have been completed, other are on track. So some of these may be longer span, 6, 9, 12 months. We'll follow on a quarterly basis and make sure that they're tracking to completion. And then action plans are really discussed with the business to make sure that it's really addressing what the issue is. Perfect. Thank you.
Thank you so much. On ethics update, Willette?
Here we go. Try it again. Good morning. All right. Well, I am Willette Stanford, Jay's ethics officer, and I have an opportunity to give you an update on ethics for 2024. One of the key elements for our ethics program is our training. Training is required of all of our employees, and we conduct what's called business ethics training for our non-management employees and open government training for our management employees. The training is delivered in two different or combination of ways. You can either have it online or you can have it in person. So one of the key pieces for our business ethics training this year was to really focus in on some real life scenarios and case studies of things that have actually occurred here at JEA. So we met with our employees and put together the training and focused in on certain areas such as conflicts of interest, secondary employment, nepotism, and misuse of resources and gifts. You will see an increase in the number of trainees from FY23 to 24, and that's based on the fact that we included our co-ops in the training, and we also allowed our managers to take it as well. It was computer-based training, so they had the opportunity to log in and review what their employees got to see. In addition to that, we surveyed our employees at the end of the training to get ideas for the future training for FY25. And we also included a video of our chief operating officer in the training, and it was a big hit based on survey results. 99% of the respondents that attended the training said it met their expectations, and 84% said it was better than or higher quality than the training in the previous year. So we felt it was successful. Our open government course was a training that was adopted for our managers, directors, VPs, and chiefs. And this course was conducted by our Office of General Counsel, Regina Ross, and the City of Jacksonville Ethics Officer, Kirby Overdorfer. So with that, we reached out to management to ask them what type of scenarios they would like to see in the training. And so several of them responded, and so they were able to really focus in on the training. But the two that came up the most were around public records and public meetings, what is required when attending those. So the training went very well, and we received awesome feedback from that. So hopefully we will continue reaching out to them in advance to ensure that we're providing the best type of scenarios in the training for them. In addition to our training ethics program, we have reporting out opportunities for our employees. We have several different channels that employees can report when they do experience or have an issue or concern involving ethics. Primarily, we ask them to contact their manager. If they're not able to contact their manager or are uncomfortable, or maybe it's involving the manager, then they can reach out to me. In addition, we do have a ethics hotline, which is managed by a third-party vendor, which allows them to either call the hotline, they can email it directly to the third-party vendor, or we have a QR code on our ethics page that they can use as well. So we try to offer as many channels as possible for reporting. This year, I'm happy to say we have not received any ethics inquiries that have been substantiated based on reviewing it. However, most of the inquiries that we do receive are labor issues. So I work very closely with our labor relations team to ensure that those cases get closed and that we contact the caller to let them know the issue has been resolved. And some of the common themes around those calls have been around workplace harassment, improper use of equipment, conduct violations, and some of them have resulted in policy updates and also discipline. What's coming up next? So several things are coming up in the future for ethics, and one of the biggest is a code of conduct. Based on some of the inquiries I've received, I felt it was time for us to update our code of conduct. So we're going to be working with a third-party vendor. We're going to have focus group with our employees to really build a code of conduct that employees will be able to use. Our prior code of conduct was about 35 pages. This one truly will not be 35 pages. So we definitely wanted something that they will find useful. So that is something that I'm working on as well. And we're hoping to include that in our FY25 training for ethics. In addition, reviewing some of our policies and procedures. By the inquiries that I receive from employees and some of the inquiries that come from the hotline, I've identified that we do have some opportunities in updating some of our policies and procedures. So I'm going to be closely working with labor relations to try to tighten some of those and just make sure that they're very easy for people to follow and they have a clear understanding of the policies and procedures. Next, continue to advance our training. A training is required of all employees, but we want to make sure it's useful. So for FY25, we're going to start meeting with employees now so that we can prepare to have it delivered in the March timeframe of 2025. And then lastly, we have a new CEO. So my job is to work closely with her to ensure that if there anything that I hear or see that's relating to ethics, that I can engage her in terms of ensuring that we're getting communication out to employees and that we're bringing awareness to whatever the issue or concern may be. So that concludes my presentation this morning. Are there any questions for me?
Well, for the hotline, the third-party vendor who runs a hotline, so does JEA have like certain criteria if it's flash traffic that has to get to either the CEO or responsible party as opposed to a more routine, issue that doesn't necessarily have to be acted on overnight? Do we have any of that like prioritized?
Yes. We work with Navix Global, who's the third-party vendor that we use, and we actually use them for our hotline and for our policies and procedures, which is really nice because there's a feature in the policies and procedures where if you're reading the policy and you realize that somebody has violated, you can click the button and it'll take you right to the hotline where you can report it. But we do have a way to escalate. So if they get a caller and it's something very serious, they will contact myself, and Lee is my backup in audit services. So they will reach out to us directly if it's something urgent. However, we get alerted via our phone and email every time there's a case in there, and we go in within 24 hours to respond to the caller and review the case and then decide what action needs to be taken. If it's something that we can do right then, we'll go ahead and address it right then. And some callers leave their telephone numbers, so we're able to call them back and get more information. And we can respond to them because they get a code that they can put in the system, and then I can respond. I don't know who they are, but they can go in anytime they look, and we update it every week. You're quite welcome. Any questions? All right, well, thank you.
Thank you. Well, this is an important area, and I really appreciate your efforts. Quarterly financial review, I think Joe is injured, so Ted's is going to take over the quarterly financial review.
Yes, sir. So for the rest of the committee, Joe had an accident this weekend. He fell and broke his wrist. And so we're I think I see he's listening, but he's convalescing a little bit. I think he has an appointment with the doctor tomorrow to see exactly what steps they'll need to do, if it's just to cast it up or if they're going to have to do some surgery. So
He's got another hand, Ted. What's the issue?
I'm here and I'm embarrassed. Good.
He's got to get ready for. I talked to him last night. He said he's got to get ready for football season. Yeah.
You know, I was going to ask if it had anything to do with the Chiefs losing, Ted. I was wondering about that. And let us know if you need some support, Joe.
Thank you.
I'm just going to pass on that, Kwanzaa. Thank you for reminding me. So
I hope you have a swift recovery, Joe.
Thank you all. I appreciate your thoughts. And Bobby, thanks for reaching out.
So we'll go ahead and jump into the quarterly financial review. So this is a new deck of slides. We changed this up, tried to give some more detail and granularity to the systems. So this first slide here is the electric system, and we're comparing a lot of things here, but I would like to walk through and hit a few of those. So if you look down at the bottom in the middle, you'll see total expenditures. So these are comparing actual spend through June 30th to budget. So we are slightly unfavorable on our total expenditures. But then if you will look to the left, you will see our total revenues, which they are favorable. So the biggest driver in both of those numbers are the two boxes in the middle. You see the fuel and purchase power revenue and the fuel and purchase power expenditure. So we have spent more, but we've gotten more revenue. This is mainly been driven by higher sales due to warmer temperatures, which we'll get into just a little bit more detail in the next slide. But you can see in the upper left-hand corner, base revenues are up as well. That again, driven by higher temperatures. And then our O&M expenditures are in a favorable position, but our other expenditures are a little bit unfavorable, and then other revenues are in favorable position. But overall, our total revenues are running ahead of our total expenditures.
Mr. Chairman, can I ask a question?
Yes.
O&M expenditures, the arrow's up and it says it's 4.9% favorable. Does that mean that our O&M expenditures were higher?
No, so that means that they were less than budget. So for an expenditure, a favorable is less than budget. On a revenue, a favorable is more than budget. So.
Okay, thank you. That's confusing to me.
And that's why we tried to put the green and red boxes. So green are the favorables and red are the unfavorables.
But Ted, to follow John's point, is this a timing issue? Are we going to? Yeah.
So I think, and we're going to go into a little bit more detail on the O&M expenditures, but we are projecting the electric system O&M expenditures to be slightly under budget for the year.
Okay.
And we'll get to that just in a couple more slides. So Mr. Baker, as we're trying to develop this new deck, can you give me a little bit more feedback on what would be more helpful to you?
If the O&M expenditures arrow was down and it was green, it would be more intuitively obvious what was.
I understand exactly what you're saying, and we'll work on that for the next time. Yes, sir. Yes. I understand totally what you're saying. Okay. So we'll move on. So this little pop out shows. So in the last slide, we were showing actual numbers to budget numbers. This little slide, this little pop out, the 4.1% is comparing our kilowatt sales from this year to last year. Okay, so a little bit different comparison, but I think that you really need to have a taste of both, right? So you understand where we are against budget and where we were last year. So you can see, as I said, we have experienced warmer temperatures than we did last year. If you'll note in the little bottom, at the bottom of this slide, it shows our heating and cooling degree days. So we've had 194 more heating degree days. We had 27 less cooling degree days. So a total of 167 more degree days. That is what's driving that 4.1% additional sales compared to last year. On our operating expenses, we'll get into a little bit more detail there, but this little pop out, the 3.9% is comparing purchase power expense or fuel and purchase power expense compared to last year. So we've seen our fuel prices go down per unit this year compared to last year, almost 4%. So that is a pass through to our customers, but that's a savings to our customers as well. So a little bit more detail on that O&M budget. So on the right, you'll see where the light blue bar is our year-to-date actual expenditures. The dark blue bar is our annual budget. And then the yellow line is our forecasted. So right now we're forecasting that our O&M spend will be about $304 million compared to our budget of $315 million. To your left in that box, we break out some of the variances in some of the areas. So we have a negative variance on our salary, overtime, and benefits, but those are more than made up for by positive variances in our supplies, other services. Now, our insurance, you see that $1.3 million kind of in the middle of that box. That savings is really offset by additional expenditures on the water side, and we'll look at that in a moment. The same thing with the net credits of $3.4 million. That is offset by some credits on the water side. But even with all of those, we are still forecasting the budget to be under budget for the year on O&M on electric.
Question, Mr. Chairman?
Yes.
I love us being under budget, but it looks like budget was up 13 or 14% versus last year. How can we justify something like that?
So part of that was the FY '24 budget over the FY '23 budget, correct?
Correct.
Okay.
315 versus 281.
281. So I believe there was some headcount increases in the FY '24 budget. And there were some other operating expenditure increases in that FY '24 budget. I've got FY '25 numbers all in my brain now. So that took place about a year ago, but we can get you a detailed breakdown of that comparison between the 281 and the 315 if you would like.
Okay, thank you.
Okay.
Well, the other big thing is, are costs, Ted, are you seeing costs coming down, or are you still seeing,
We're still seeing costs going up. We're seeing it going up at a slightly lower pace, but still going up.
Wow.
But if the FY '25 budget, we held steady. So the electric systems O&M FY '25 budget is also $350 million. So that stayed, we worked very hard to make that number flat for the coming year.
Ted, following on Mr. Baker's question, is there a corresponding increase in revenue due to higher, we were able to charge more, so that's offsetting the expenses costing us more?
So there is higher revenue, but it is off, that revenue is driven by rate increases. So we have seen flat revenue increases when we weather normalize. So we'll go back one. So we showed that increase in degree days. So we're having a hotter than normal summer. So if we had a normal summer, our sales, we would project them around 12.2 million. So that has been flat since about 2009. And while our number of customers has increased around 2% annually, there has not been a corresponding increase in sales. And that is driven by a number of factors, but the biggest one being conservation. And so the average residential customer uses about 20% less electricity than they did in 2010. And so from a finance person's perspective, that is a challenge. You continue to have our cost increase, and we continue to grow our customer base, but we are not increasing our unit sales.
As a follow-up to Bonza's question, it would be very helpful if we had some cost per kilowatt hour figures in these things, because that's what's scrambling my brain.
Thank you. That's the exact kind of input that I'm looking for. So we will work to make sure we get that kind of information in these decks.
Just one question, follow up on that. Obviously with the hotter days, I mean, the biggest thing of that is fuel. So, and that's a direct pass through.
It is fuel, but we do also have a margin we make off of every kilowatt hour. So as we increase those kilowatt hours, that we get that additional margin.
Okay, all right, thank you.
Question, excuse me, Chairman. Ted, you mentioned a minute ago we were going to be flat going into 2025 on expenses. Is that based on the 315 we had this year, or the actual what you're projecting we're going to end the year at 304?
So it's based on the 315, but that is only the O&M expenses. So we will we have the increase in expenses from Vogel. which is in our purchase power number, not our O&M number. So that additional $247 million, I think, from those costs are not staying flat. I mean, they will be flat now that we've, but FY25 will be the first year that we have both Vogel units 3 and 4 online for a full year. So those costs will increase.
Thank you.
But the other increased cost is labor and overtime. Do you have any point of view there?
Yes. So those labor and overtime, that is part of that 315. So we've been able to offset the we have 70-ish% of our workforce has a contract, and we have obligations for the in FY25 for those increases. And so, but we have found savings in other areas to offset those increases in salaries. And we also have increases on some of the items that we are purchasing, right? There again, we've worked to find some offsets with that. So just one small example is landscaping. We've worked with our landscapers, so some of the grass won't get cut quite as often to offset, to save some money, right? And so we're going to keep our properties neat and tidy. But we're going to work to offset those costs where we can.
Ted, it's Joe. You've also talked about right-sizing some of the headcount additions that were planned for both 24 and 25, thinking specifically about the strategic planning area. A number of those positions will not get filled. We're really right-sizing across each system to address the salary and benefit increases, to Bobby's question.
That's smart. So thank you for sharing that as well, Joe. Just a question with the anticipated more active storm season. Is there anything that this committee should be aware of? Are you anticipating that overtime costs would exceed what we've planned for based upon the more active storm season?
That's a great question, Kwanzaa. Preliminarily, we incurred about $2 million of costs in the electric system for what became Tropical Storm Debbie. At this point in time, FEMA has not declared a disaster for Duval County. So what originally gets booked as capital will become O&M. So we have to be mindful of these costs, and the additional overtime, while it wasn't a significant portion of that $2 million, we're being impacted by it. So I'd say the 304 number is inching up a little bit.
But if we were hit by a substantial storm, we would see most of those costs reimbursed to us by FEMA. It would be a challenge. The challenge for us would be the cash flow so we would be spending that money immediately to get our customers back online. And then the reimbursements come a little bit more slowly than that. And so, but we have finance mechanisms to bridge those gaps. So I think,
Chad, I'd also say FEMA's begun to accelerate its reimbursement process. If it were a major storm, I feel more confident, and the state reimburses, FEMA reimburses 75% and the state reimburses another 12.5%. So 87.5% of those costs would be recouped. And if it were a major storm, a Cat 3 or something that created a significant amount of damage. FEMA has stepped up and financed, they bridge financed on a more expedient basis.
And also our emergency preparedness team has done a very, very good job in working with the state's emergency management. We're top of the class in that area. And so we have done the training and provided the information on the front end so that we would be qualified to get those monies faster in the future. So.
Just one more question out of curiosity. Do those predictions come out in enough time for you to be able to plan for how active the storm season will be based upon? I don't know who puts the prediction out. I got it from NAS Jax last year, but
So
are you able to take those into consideration?
So yes, we are. Luckily, we've last 2 or 3 years, we've kind of dodged some bullets. So the storm that we had earlier this year, you know, all the weather reports was that it was just going to be a glancing blow, and it was. In the past, in my short tenure here, we've, you know, 4 or 5 days out, it looked like that it was coming directly over Jacksonville. And it turned and went another way, fortunately for us. Not so fortunate for maybe some of the folks south of us. So we are prepared for whatever comes our way. We prepare for the worst. Both from a financial standpoint and an operational standpoint. And then if it doesn't come to pass, that it's bad, we say thank you and take a breath come December, and then come June, we get all ready again for the next year.
And Ted, to Kwanzaa's, to her specific question, that the budget submitted well in advance of the hurricane season I don't think the hurricane season projections come out till March or April in terms of the forecasted severity of the season. And now forecasters are actually saying it might not be as bad as what they originally projected. So we are moving toward reinstating a reserve margin for O&M and probably for capital as well. Prior management had eliminated that contingency. It's probably not a bad idea. The council auditor has suggested that we revisit the approach. And so fiscal year 2026, you may see a slight contingency to account for these storm funds. Historically, to Ted's point, we've lucked out, and Ian was by the largest damage cost to our systems. It caused about 32 million in damages, which we're still collecting from FEMA. So, but compared to utilities statewide, we fared rather well in terms of actual damage to our systems.
All right, we'll move on to electric system capital budget. We're going to be really close on this one. So the budget's 271 million. Our project managers, that's PM forecast spend, is at 275. Our capital budget team's forecast is 270. So I think we'll be right, very close in that neighborhood. And you can see some of the key drivers on the left-hand side. You know, new development of our system. That's our system growing. Those are those additional customers we're adding. But unfortunately, they're not using more power for us. So Any questions on electric system capital before we move on? All right, so we'll jump into the water. So a few more green boxes on this one. So the only variance that we have on O&M is O&M expenditures are unfavorable by over 6%. We'll talk about that in a moment, but you will also see our total expenditures are still in a favorable area compared to our total revenues, which is in a favorable area also. So overall, we are positive, and we'll dive into these a little bit more detail unless anyone has questions on this slide.
Ted,
Yes, sir.
it would be helpful to get your thoughts on what is an appropriate surplus percentage, to fund ongoing debt repayment and so forth, because like
Landon, what's going on?
And we've lost volume, Landon.
We've lost, video and
And video as well. And the chat's unavailable. Let me send a text to Ted to let him. I'll text Vicky. I'll send Ted a text as well. Said Landon took it down. He's trying to fix it, Bobby.
okay.
I don't know why we're still using WebEx, but there we go.
Here we go. We still don't have.
Chair Stein, can you see and hear us? I think you're on mute, sir.
We're good to go.
I can hear now.
Okay, all right. Thank you.
Sorry.
So that's no problem. So, we're sorry. Here's the same slide we had for the electric system, for the water system.
What was John's comments that I missed? Yeah.
my question was, it would be helpful on the surplus to know what the CFOs thought of what the surplus should be to adequately, fund our operations, because we've got 44 million of surplus of water and 25 at electricity. And those are, I like the green arrows, but I have no sense of whether we're making too much, or whether we're just making what we need to make to fund our operations.
Great question.
And so we'll incorporate that into the deck going forward.
Joe?
So what now, can someone advance the slide, please?
Yeah, that's a great question. I think we'd look at some kind of percentage of net revenues, 5% of but we'll take a look at that. Hadn't really thought about it in that way, but it's a great question.
So this slide is talking about water-based revenues. You see that our water KGAL sales have increased by 1.2% compared to the same period last year. Here again, this is a year-to-year comparison, as where the previous slide was budget to actual comparison. So while I said on the electric system, we're not seeing much growth on the sales because of conservation methods that have taken place. On the water, we are seeing some growth both in the customer base and the usage. So you can see that we actually have had a little bit more rain this year than compared to last year, but we are still having water and sewer KGAL sales increases. So that's a positive metric, in my opinion.
But getting back to John's question, Joe mentioned 5% of net revenue. Also, Joe, it'd be worthwhile getting what's best in class.
Yes. Yes. So we can do the research and
Will
turn
do.
that.
Yeah, it's interesting. On the electric side, we've always taken the surplus and we pay down debt. And that surplus generally arises in the electric system because our sales exceeded the 12.2 million megawatt hours. So on the water side, we haven't seen these kind of surpluses. So it's something we need to take a look at for sure.
Well, to that point, Joe, might it be helpful to see a comparison to last year so we can see just how we're pacing even against ourselves?
Absolutely. Yeah, and we'll do that by system. Ted mentioned over the past couple of years, we've been able to fund the non-fuel purchase power rate stabilization fund to the tune of 246 million. It's a sizable number that really has resulted from base rate increases in the last couple of years. So, but we knew that, and we were intending for that money to be used toward reducing the base rate increases that we're projecting over the next several years. So we certainly would like to take a look at that data and come back to the committee.
Yeah, I just think it's what is best in class doing in our, similar type municipal utilities, and what is our goal of how do we, meet that or exceed that?
Yeah, we submit, as you know, Bobby, a balanced budget.
Yep.
But then things seldom come in balanced. So it's a great question. And frankly, we really hadn't tracked that at least since I've been here. It's a great thought from the committee.
John, do you have any follow-up on that question?
No, but I loved what I heard, that we put the extra money into our, what do you call them?
Rate
stabilization.
Rate stabilization.
Rate stabilization.
Yeah.
That takes a lot of the worry away from it. But that's a great pivot to bring that back.
You bet.
All right, so on water expenses, you will see that this 9 months compared to last 9 months, pretty flat, 0.001%. So that's probably about as flat as we can get. Moving on to our water system operating budget. So you'll see that total revenues are up for the year, both on water and sewer. Reclaimed is a little bit lower. Remember, these numbers are at June 30th. So we've had a active July and August with people watering their lawns. So, and then on the expense side, running slightly below budget there. And so our water system O&M budget, we are forecasting that to be over budget. So you can see that the yellow line is the forecast there at $254.4 million. That is higher than the $236 million. If you will look to the left, you can see the drivers behind that. So 4.2 million of that is in salaries. 3.1 is in supplies and materials. That is mainly chemicals at the plants. You see those intercompany charges of 2.5 million. So that surplus, that's a negative number on the electric side, but then it's a positive number on the water side. The same with insurance. We reviewed how we allocated those insurance costs and some of those intercompany charges during FY24 and have dispersed them a bit different to be more fair on who pays for what electric pays for and what water pays for. And then on capital, here again, I believe we are going to be very close. As of June 30th, the project manager's forecast was at 514, the budget's at 514, and then the capital budget team's forecast was slightly lower at 495. Here again, you can see some of the specific drivers on these projects. And then our financial metrics, these should look familiar to you. This is very similar to what we've been showing you in the past. So the top half of the chart is the electric system. So our days of liquidity, we are meeting our target of 150 days at 236 days. Our debt service coverage almost 5% with a target of 2.2%. And then our debt to asset ratio is down to 44.1% with a target being 50%. Back to Joe's comment, in years past, we were taking that surplus and we were putting it into paying off debt. That's how we've been able to, over the last 15 years or so, go from a 90% debt to asset ratio to a 44.1% debt to asset ratio. So our fixed charge coverage is slightly below the target of 1.6. We do think by the end of the fiscal year, we will be at or very close to that 1.6. And then our weighted average yield of investments, we have been lagging behind that as interest rates have increased over the last several months. But you can see we are closing the gap and we are only 17 basis points behind. So depending on what happens with interest rates over the next few months, I feel that we will close that gap and have a green check box in that area. On the bottom,
Ted, the month of July was actually at a 480. So we're closing that gap.
Yes, thank you, Joe. So, and then on water, still, we are, our days of liquidity, 137 compared to our target of 100. Our debt service coverage ratio, 3.38 compared to our 1.8. Debt to asset ratio of just below 40%, our target 50%. Now, both on the electric and the water system, we'll be issuing more debt in FY25, which will have those ratios going back up. But we have some room under our target that we're can work with, and so we'll be continuing to do that. Fixed coverage charge is not an issue on water. We're at almost three times versus the 2 times target, and then our investments are the same. You know, we use this same investment pool on water and electric, but there again, we're closing in.
But one thing we all got to be aware of is we've got aging assets and in the water system, growing assets. So, you know, we're going to have to be spending money. So, you know, keeping an eye on this number is great, and having the availability with both surplus and, you know, ability on our balance sheet to do these investments. But we are replacing older assets.
Hey, Bobby,
Yes,
to
sir.
your point, for 2025 for the budget, depreciation in water's projected to be just north of 200 million, and we're spending 567. So that tells you all you need to know right there.
All right, so this is my last slide on this. Appreciate the input. We will incorporate information on surplus, cost per kilowatt hours, change the arrows depending on if they are revenues or expenditures. And so I had a couple other questions, a little bit more feedback. We were thinking about doing this on a quarterly basis. Is that a pace that you would like? I'm afraid if we did it on a monthly basis, the first few months of the year, one data point does not give a trend. So that's why we were thinking about quarterly, but be happy to do this at any pace that you would like.
I think it's great. I would go on the dashboard, just get John's feedback of what improvements you can make. And yeah, I mean, I just think we got to watch overtime. We got to watch, cost of everything is going up, and not at the same pace, but it's at a high percentage, and we're going to be spending money. So I think this is a good dashboard to look at. So I appreciate Ted and your team pulling this together.
Thank you so much, Bobby. So my last question on this, and then I'll be quiet for a little while. Would you like this presentation both at the committee level and the board level, or would you just like it at this finance committee, and then we can put it in the supplemental information with the board committee? And when Chair Stein gives his summation of the finance committee, he could mention anything that he felt needed to be mentioned at the board level. We're happy to do it either way.
I'd be interested in input from the committee.
Mr. Chair?
Yep.
I think some of this does need to be in some of these major charts and so forth, but probably not to the level of detail. But I don't think it should just be pushed to the supplemental information. So some of the dashboard information, I think, is helpful even at the board meetings.
Okay. Well,
Rick, why don't you give Ted input on what you think is necessary for the board meeting? That'd be appreciated.
Sure.
Yeah.
Thank you very much.
Hey, Bobby, this is Joe. I got one question. Ted, getting back to this chart here, I'm just surprised that the water debt to asset ratio, it being that low right now. and maybe I'm missing something, but I'm getting back to the capital projects committee meeting we had last week where, I mean, a lot of stuff is happening and all that. So I'm sure this is going to inevitably increase, right?
Yes, sir.
Okay.
Yes, sir. We are going to, over the next few years, start bumping up on that 50%. And depending on the timing of issues and how things cost finally break out, we might have a year where we go 52% or 53%, but we'll have a good discussion about that when we are a little bit more sure of those numbers. But right now, what we're planning is even that we may press that 50%, we're going to be back down in a year or two, back down to that 50%. Some of those numbers are a little squishy. But as we put together our 5-year capital plans and we start looking out on that, that's what they're telling us now. But I know year 1 and 2 are pretty good. Year 4 and 5, there's a little bit more unknowns in those numbers.
Senate Bill 64 is going to impact this as well. And I would add, Chair DeSalvo, to your question, historically, electric just had much more ground to make up in terms of getting down to 50%, below 50%. As Ted pointed out, they peaked north of 90% debt to asset ratio. Clearly not a sustainable business to be running at 90% debt to asset. Water got down to 37 at the end of last fiscal year. So they're creeping up a little bit, but they'll creep up a lot more based on that capital spend over the next couple of years. That was a great question.
Yeah, but that goes back to the point of some of that surplus might not go in the rate stabilization. Some of it might go to cash flow to offset some of this.
Yeah, in fact,
Yes,
we're looking at the surplus in both systems no longer going into the non-fuel purchase power in the case of electric specifically, Bobby, but water as well. We would use that money to reduce our borrowing the new money bond issuance amounts. It's exactly what we had in mind.
Joe, you might have a broken hand, but you're still really good.
I don't want to show it to you right now.
Yeah. So Randall, I'll hand it over to you. And again, I want to compliment Ted and his team pulling this thing together on the de-risking opportunity. So Randall, Ted, Joe, AJ, thank you for all the work that y'all have done on pulling this together.
Thank you, Bobby. Again, Randall Barnes, I'm treasurer here at JEA, and I am here to give an overview of an electric system debt portfolio de-risking opportunity and also provide an update on where we stand at this point. But just for background, currently the electric system debt portfolio is about 95% fixed, but it's fixed in 2 different ways. 2/3 of it is fixed with fixed rate debt, which is just typical fixed rate debt with no variability in the interest rate that we pay. Another 28% of it is actually variable rate debt, but it's been synthetically fixed with interest rate swaps. So we have swaps that are fixed payments, and we also pay variable rate, but we receive a variable rate to offset that variable rate. So variable rate debt that's synthetically fixed with swaps carries various risks as relative to fixed rate debt. And it also adds costs, complexity, and a significant amount of administrative burden. The current market environment, because of the absolute level of interest rates and also because of the ratio between taxable and tax exempt rates, give us an opportunity to refund the variable rate debt that are synthetically fixed and with fixed rate debt and terminate all of those swaps at an approximate net present value break even. This would reduce our variable rate debt to approximately 2% of the electric system debt portfolio. It also eliminates 6 interest rate swaps and 6 liquidity facilities. So this is all subject to the market environment, and so it's very sensitive to market conditions, and for that reason, we've gone ahead and started the process of moving forward with the transaction to accomplish this. The JEA board has already given us authority with the delegated authority to do this transaction, but we're here to make sure you're completely informed and answer any questions that you might have. So just moving forward, just to give you a visual, on the left-hand side here, we have the current debt system portfolio showing the 67% that's fixed rate debt, and then the 28% in the orange color there that is variable rate bonds that are swapped to fixed rates. In addition, there's another 3% in the sort of light orange color. Those are variable rate bonds that are unhedged, but they have the same liquidity facilities as a swap bond. So those are the ones we would also want to fix out. And so if you look to the right, after the de-risking transaction, we would have almost all fixed rate debt and only 2% of variable rate debt on the electric system portfolio. So just to quickly go over why we think it makes sense to do this. Number one, it's going to extremely simplify JEA's balance sheet. It would eliminate all the electric system swaps, convert to a true fixed rate debt with basically no cost, reduce administrative complexity. So we have financial reporting, continuing disclosure things that we have to do. On the variable rate bonds, we have a lot of payments, operational type things that we have to do. And then in addition, just from an overall communication standpoint and dealing with the board and the city council and any other stakeholder here in Jacksonville, when you get into variable rate bonds and swaps and things like that, it's just much more difficult to communicate, especially when you're talking about a fixed rate payment. It also is going to remove a significant amount of dependence on bank support. So all of our variable rate bonds have to be supported by banks in some way or another. So there's costs associated with that. Also, remarketing fees are things that have to be taken into account because we pay banks to continue to remarket those variable rate bonds. Those liquidity facilities, they don't exist for the entire term of the underlying bonds. So we have to renew those from time to time. And there are lots of, there's potential for increases in those costs as time goes by whenever you come up on a renewal. And then also, the more that you rely on credit capacity, the less banks may be willing to provide it. So by removing all this bank support, then if we ever need it, it's easier for us to get from other banks. Swaps themselves carry risks. There are what's called basis risks. So it's the risk that the swap receipts do not offset exactly the variable rate that we pay. And then also the cost to terminate swaps is significant. And I'll get into that a bit more on the next slide. In addition, we're going to have the opportunity to reshape the electric system debt service, the profile of the debt service. So I'll get into that a bit more. And also, when you issue fixed rate bonds, they're in the municipal market, they're typically callable. So you have, 10 years from now, there'll be an opportunity to refinance the bonds that we issue to pay off these bonds at a lower rate if the market allows us, if it makes sense. We don't have that option now with the swaps. We have to wait until the bonds mature. Just to provide a little context for why we're doing it now, if you look on the chart, the termination costs for the swaps on the electric side vary every single day. But if you look at the last 10 years, the cost to terminate these swaps has been over $140 million, a few times, and never as low as they are in recent years. So currently, the last run that we did, or a recent run that we did, actually that was a little bit dated. We did another one that was about the same amount. It's about a $30 million cost to terminate all of the swaps. Again, that's a cost that's built into the refinancing that we're talking about. So we're still getting a approximate net present value break even, including that cost. But that's significantly lower than what you see there in previous years. Again, those swap termination values change every day, so we're constantly monitoring those valuations to ensure that the transaction continues to make sense until we actually price.
When will you price?
Good question. The pricing is set up for September 17th, so we're well on our way to pricing the transaction. Just to kind of frame up the entire transaction here, there are actually going to be three components. The first is the de-risking. So it's about $377 million of variable rate bonds that will convert to fixed rate bonds. As of this run that we had, it's approximate 1.8% negative PB savings. Again, that's pretty close to a break even. We're never going to be able to pin it exactly. We'll continue to monitor that in case it gets to a point where, and to make sure that it doesn't get to a point where it's not economic to do the transaction. But we don't anticipate that. And based on recent conversations and reviews of the market with our underwriters, the market is continuing to cooperate. The second part of this is, since we're going to be going to market, it makes a lot of sense for us to go ahead and current refund any fixed rate bonds that make sense. So here we have identified about $61.5 million of currently callable bonds for savings, with a 13.3% of savings of the par refunded. That might grow a bit. We've had a little bit of a rally in rates. So to the extent that additional callable bonds make sense, we'll bring those in as well for additional savings. And then finally, the third piece is that small piece of unhedged variable rate bonds that will convert to fixed, just because they have similar liquidity facilities. And that'll be a savings of about 5.3% of the par refunded. And that's based on assumptions on the variable rate bonds, but those are conservative assumptions, and it makes sense for us to do those as well. Overall, this is not an activity where we're trying to have major savings. Overall, it's about a break even, a slightly above break even NPV savings. That's why we call this a de-risking transaction. It's something to take off significant risks and complexity from the portfolio. And this is not what Ted was talking about when he said we might issue bonds in fiscal year 25. These are not new money. This is all refunding. Real quickly, just wanted to show you, I mentioned restructuring a moment ago. We are going to take the opportunity to restructure the debt maturities within the debt service portfolio to the extent that it can provide us savings in fiscal year 26 and 27. And we're able to do that. I think it's about $11 to $12 million of savings in fiscal year 26. So that'll be helpful as we move into the next couple of fiscal years and stair step our way into the next few years' budgets. And we also are doing some slight adjustments to try to levelize fiscal years 29 through 33 and then 34 through 36. Again, no significant changes and all within the bounds of our debt management policy, but just trying to make things a little bit more levelized. And that's all I had prepared today. I did want to mention, you kind of stole my thunder, but work is underway on this transaction. We got kicked off the week of the 5th, August 5th. The team and various folks throughout JEA, sorry, that's not the first time I've done that at a board meeting. Various folks throughout JEA have been very helpful to help us put together the preliminary official statement and on due diligence questions and questions that are going to be asked of us by the rating agencies. So we're hard at work. We're a very good place with the preliminary official statement and the bond purchase agreement. We're working on the due diligence questions from the Underwriters Council. We have meetings set up with rating agencies next week. They've provided us a number of questions. And then, to your point, the pricing is set for September 17th with closing on October 1st. that's the current schedule. So happy to answer any questions you all might have.
A lot can change
Yes, sir.
in a month, so keep us up to date.
We will, and we'll come, I'll be in front of you at the board meeting next week, and I'll have some updated figures, more current figures. Thank you.
Again, I want to thank the team. A lot of work's gone into this. Next is the water sewer cost of service update, Ted.
Thank you. I'm going to keep my comments brief because you've heard enough of me already, and I've got more stuff to talk about before the meeting's over. So,
Victor?
Good morning, sir. Good morning, committee. Victor Blackshear, Director of Financial Planning and Rates, and I'm here to walk us through our water cost of sewer study. Thank you. Okay, so according to our pricing policy, we are required to take a comprehensive look at our cost of service study at least a minimum of every 5 years. The last time we did a water sewer cost of service comprehensive cost of service study was in 2019. So this year we initiated another cost of service study for our water sewer system, and the whole purpose of that is to make sure that our rates are based on cost. As a refresher, our cost of service process involves 3 steps, but these 3 steps take 6 to 9 months to go through. It first starts with our revenue requirements and ensuring that we first take a look and see if our revenues are adequate to our revenue requirements. And then we get into the weeds with our cost of service to see how our costs should be recovered by class. And then the last step is to see if our services are priced adequately. For all intents and purposes of this presentation, we will be focusing on the first 2 steps. So for this cost of service study, we utilized our FY24 budget as our basis, as our test year. As you can see from FY23 to FY24, that budget had increased by $8 million. So we decided to hone in on FY24 for this cost of service study, but in comparison with our FY25 net revenue requirements, it is $519 million, but again, this study is based off of FY24. So once we have identified our revenue requirements, then we have to take those revenue requirements, those budgets, and separate them. We functionalize them by cost. On the water side, we put them in different buckets from what does it cost to supply water, what's it cost to transmit the water, to distribute the water, and likewise on the sewer side, we break those costs down. We determine how much does it cost to collect the sewer and to treat the sewer, et cetera, et cetera. And once we functionalize those costs, then we allocate those costs to the classes. And the way we allocate those costs by classes is based off of their characteristics and their usage. Once we do all of that analysis over the 6 to 9 months, then we get to a point where we can see exactly how much does it cost to serve each and every class, which leads us to that third step, and that's to stand up our projected revenues to our projected revenue requirements to see how well we're performing in a given year. As you can see here, focusing on the box, the dotted line box there, for FY24, overall, we're 100% on collecting our costs, which is a good message. But when you peel it apart, I like to say when you pull the onion apart a little bit, you can kind of start to see where there's opportunities. So on the water side, we're collecting 92% of our costs, but on the sewer side, we're collecting 107% of our costs. So the next couple of slides, we're going to get into the details to show exactly how that pans out at the class level. Just to give you a graphical depiction of what I just mentioned before, as you can see here from on the water side, how our revenues compare to our cost of service for the water system, and how our sewer revenues compare to the cost of service on the sewer system. And you can see we're under collecting 19 in the water and over collecting 19 million in the sewer. But when we pull that apart and we look at it at the class level, that's when you really start to see some of the opportunities. So you can see across the board, most of our classes were under recovered. except for our irrigation commercial customers. The one that has the most disparity is the multifamily, where you can see there we're 70% under recover, which sends us a signal that that's definitely an area that we want to look into as we move forward into our step 3, which is our rate design process. But overall, our total overall water system projected under recovery was $19 million. Conversely, on the sewer side, we're over recovering, and we can see where our over recoveries are taking place there. And again, across the board, you can see that there is over recoveries taking place. However, what was revealed in our study is we're significantly under recovering for our high strength, excess strength sewer surcharges. And what that is that's our industrial customers who are sending us waste and sewage that's well above our domestic strength treatment of our sewer waste. So they are charged a surcharge for it. We have a team, an industrial pretreatment team that goes out and samples their waste to determine how much we should be surcharging them to treat that waste, because it takes a lot more work to get that cleaned up. And then hauled waste is waste that comes in by truck. And it comes from the city's landfill, it comes from septic tanks, it comes from shipped water, and it's shipped to Buckman treatment plant to treat that waste as well. It's some nasty stuff. So it takes a lot of work and a lot of cost to get that treated. And you can see here that we're under recovering that as well by 54%. So again, these are giving us insights in terms of where there's opportunities to address our rates. So with that being said, we've been doing this study and we're still undergoing the rates part of this study with our rate consultant, Stantec. They are consultants. They've been doing this for over 30 years. They've been assisting us along the way. And they're helping us now move into that next phase, which is improving our rate structures and trying to achieve those cost recoveries at that better level, which is targeting 100%. So with that being said, although we've been conducting our cost of service water and sewer system studies every 3 to 5 years, we have not adjusted our rates since 2012. And because of that, we're going to take a look at everything. Pretty much across the board, we're going to be looking at our water, our residential, our commercial, our multifamily. We're going to look at everything. And we're digging in to see where the opportunities are to even change some of the structures, to send even stronger conservation signals. In addition to the more known retail rates, we're going to look at also our other commercial rates, which is our fire lines, which is our sprinkler systems that protects our commercial properties in the event of fires, high strength sewer, which I've just explained earlier, as well as hauled waste. And then we also have a small section of our customers, which we call bulk reclaim. And those bulk reclaim customers are customers that are near our facilities, our reclamation facilities that receive our non-pressurized and interruptible reclaimed water occasionally. So with that being said, our next steps is to move into that step 3 that I mentioned at the very beginning, and that's to take a look at our rate designs and our rate restructuring, our rate repricing. So we're planning to come back to the board in October to conduct a workshop based off of our FY25 revenue requirements. Any questions? Thank you.
Victor, that's a very clear presentation. Thank you.
Thank you, sir. Appreciate it.
Well done, Victor, Ted. Ted?
Thank you. Yes, sir. So this is my last one, and I'm going to be quiet for the rest of the day. So as you're aware, we have changed the delegation authority to $50 million. And we have talked about a number of capital projects within that new parameter at the capital projects meeting last week. But we still have a few contracts that are over that $50 million that do not fall into a capital project. And so we wanted to make sure that we brought these before you. We've got a couple that we are asking for the committee to recommend to the board to increase, and we'll go over these as quickly as I can. So here's a list of the 9 contracts that we have that are over the $50 million threshold. I'm going to focus mainly on those top 2 because those are the ones that we're asking for action on. The other 7 is basically for informational purposes. And that third one, the GE long-term service contracts, we have talked to the board about that back in May. So the first one I wanted to talk to you about was with Wesco. So this is for transformers. So our current amount is $95.9 million. We've spent a little over 60, or we've encumbered almost $61 million of that. We are requesting that the board approve an additional $27.8 million to cover forecasted needs through the term of this agreement for a new not to exceed amount of $123.8 million. This is, well, you're all aware of the issues that we've had with transformers over the last couple of years. We are getting our feet back under us on this, but the price of these transformers has increased, and the lead time on these transformers has increased. So we are having to order more of them to have more on hand so that we can be ready for the development when it comes. Be happy to answer any questions before we move on. All right. So the second contract is with WorkSpin. So this contract is the managed service provider with all of our contracted employees, not our JEA folks, but contractors that we use to help us throughout the company. So this contract is at $85.5 million right now. We have currently encumbered $7.3 million. What we're asking for on this, again, is to approve an additional $11.7 million to execute the remaining 1-year renewal for this contract that will take us to $97.2 million. And then that will get us through the 6th year of this agreement, and then we will rebid out this. So here again, this is our ask is for a recommendation be made to the board to approve the additional cost for a 1 more year renewal on this, and then we will rebid out this contract. Happy to try to answer any questions you may have on this one.
Just trying to understand exactly what these people do. What this is a temp agency? I don't understand.
It's a very sophisticated temp agency.
Right. That's right. I didn't want to specify.
So that's a list of all the different groups that use the contractors within the company. So everything from our electric generation at Northside Generation, it is using about $1 million of that. Our meter services right now, we're using around $3 million a year on that contract with them, as we are our old AMI meters are failing and we're replacing them with new meters. Those are the 2 biggest areas, but there are areas in wastewater treatment support. There is money spent in technical services with IT people that we bring in to help bridge gaps on projects where we may not have the expertise in a certain area, but it doesn't make sense to hire a new employee because it's for a defined project term, right? Or to manage a project. Like I said, it is from the people that are working on the rebuild of a turbine to somebody who is a computer support person and everybody in between.
Have we done an analysis to see whether that's the most favorable way of
Yeah, yes, sir. So in many of the areas, and you may remember, when we were talking about the 24 budget, we had a number of folks in TS that we were transitioning from contractor employees to JEA employees. They had been working for JEA for a number of years, right? And it was actually cheaper for us to have those as our employees than to pay for them through a contracted services and the overhead that comes along with that. So yes, sir, we've looked at these. So a good example is the meter readers, right? We're spending a lot on meter readers, but we're replacing all of those meters. So hopefully in a couple of years, we won't have that cost anymore. Everything will be AMI related. These projects when an outage and they rebuild a turbine and we bring people in. Once that project's done, they go away. There's just a need in certain areas, but we continue to look at that to determine, is it the right using a contractor or having an employee and trying to balance that for what's right.
So I'm supportive of this process because I know it's a great way to be able to flex your workforce without having to worry about doing layoffs and things like that to manage headcount. But you did just say something concerning to me. You have a number of these contractors that are found to be on the workforce for a number of years, just so you're not getting into co-employment issues. Is this vendor looking at that for you and helping you to manage that they're not on staff as contractors for longer than they should be?
Yes, ma'am, and maybe somebody from HR would be better suited to answer that. But yes, I understand exactly what you're saying, and yes, we try to word those contracts and have that employment set up so that we don't get in trouble with the IRS or workers' compensation or whomever could come back and audit us on that.
Great question. Do we need action on both of these?
Yes, sir.
Is there a motion?
So moved.
Second.
Any discussion? All those in favor?
Aye.
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 So for the sake of time, you have the information on those other 7 contracts. Like I said, one of those we've discussed, the GE one. As there's a couple of these that we will be coming back to you on probably a little bit later to extend, if it's warrant to extend those projects. We're just not ready to do that yet. We haven't gotten the numbers yet. But wanted to make sure you at least had a list of those. And then also, I think in your packet behind this is a list of the contracts that are in that 24 or 25 million to 50 million category that it was asked that we provide backup information on that. Be happy to answer any question on those now, or if you review those at a later point in time and have questions, just feel free to give me a call. And if I don't know the answer, I will get the right answer for you.
I'll just say, sitting in on the capital projects that Rick and John headed up, it is a big benefit just to understand. So I appreciate that committee. Yeah.
Well, thank you, Chair Stein. With that, if there's not any other questions, I'm finished with what I was going to review today.
And I think Vicky has a few comments that she wants to make.
Thank you, Bobby. Just a couple of things. I had a clarification just to make sure that I understood. For the financial metrics that we came up with for you all, that finance came up with, would you like to see those in total, both at the finance committee and the board meeting quarterly, or just the board meeting quarterly? Would you like us to do them in both finance and board quarterly, or board quarterly?
I think finance is what we talked about, and then Rick was going to work with Ted to put together metrics that are a little bit more summary in fashion that we do in the board meetings.
Okay, and hopefully we put this together because some members had asked for more of a drill down in our finances, so I hope that this addressed those concerns. Great. A couple of things that I noted, some things that you said are things we're working on, the dollars per megawatt hour, dollars per kgal, to try and get those metrics out for our O&M spend. It's hard to get apples to apples because utilities don't share that too often, and they all have different ways they account for stuff. But our business excellence consultant that I'm so excited is finally going to be presenting the 2 finalists next week to the board. Will hopefully have that data readily available and can help us with that from other utilities. So I'm really looking forward to that. I appreciate all the board members, most of the board members being here, even if you're not a member of this committee. I really appreciate that, taking the time to come and listen. It means an awful lot to all of us. Also, I am so pleased with Willette and Lee and bringing back, and also E&Y, and bringing back the executive sessions starting next week with the board on our ethics and everything with you all, and keeping you informed and having that open feedback with you and our officers charged with that. So I really appreciate that as well. And the work spend contract that you brought up, we had a very deep discussion on this at a recent meeting when we were reviewing this. And each area is looking at that contract to see if there's better ways to do it. If someone's been on there for years, they should be an employee. And does it behoove us to move them as an employee, and can we save money? And I don't know, we're looking at turnover also with that, because some areas are not pleased with that contract, which is why we're gonna rebid it at the end of this term. So when you look at turnover rates and everything, it makes you think, is there a better way? So I appreciate that from our HR executive board member. Thank you. And that's all I had, Chair Stein. Thank you.
Well, any old or other new business? With that, we'll end the session. Thank you, everybody, for your time. I really appreciate Ted and his team for pulling all this stuff together. A lot of really good work. So thank you guys, and have a wonderful day.
Thank you.
And
Staff is dismissed for this portion of the meeting. You'll move into the committee discussion session for your executives.
Thank you.
Waiting outside. I don't know.
Drive safe, John.
Thank you.
And for those employees that are being dismissed, those includes those that are logged in online as well.
Thank you, Regina. Are we ready to go?
Yes, sir.
John? Do you have any thoughts?
Just a couple things I wanted to make sure the committee was aware, because we do have some new members. First, I know we had a discussion on FEMA and the claims, when you're able to claim reimbursement from both the federal and state. JEA has been working with Ernst & Young's federal claims group for a number of years. And what we do is we help you guys accumulate the information to expedite it, because it can take, for some of the bigger storms, as you all know, 2-3 years before you see that reimbursement. And the ability that our team has is, they were all people that worked for FEMA. So they're able to make sure the original submission is complete. So there's less back and forth, and it expedites you getting reimbursed. And, that's been a valuable service, I think, to JEA. And we've been able to cut that 2 to 3 years in most cases to a year or less. So just wanted to make sure you were aware of that. Also from ethics, you heard from Willette that there is you have an ethics hotline, and just wanted you to know that Ernst & Young, we do review that ethics hotline, just to make sure there's nothing there that would be of an external audit concern, such as a violation of a law or regulation that we would have to report, not just to you, but externally and things like that. So we are taking a look at that. And the other thing I just wanted to mention, just to make sure it's on your minds, but with the advent of AI, whether it's AI that JEA is using, creating, developing, or that your external parties, your vendors, business partners, et cetera, are using, it's just making sure that you're communicating with your IT folks and you're comfortable with the controls and everything that's in place to prevent loss of information, or potential, hack to your systems. So just, again, that typically would fall under an audit committee because it is controls and processes. So you should be, and I do know you get reports from your IT folks from time to time that you should be taking a look at that. From an external audit perspective, we're looking more at the general controls around that, so access, password, and things like that. But a lot of the operational things we don't look at from an external audit perspective. So just wanted to make sure the committee and the board as well, you have a handle on, the use of AI here and what controls and measures are in place around that to prevent any unauthorized either loss or access to your information. That's all I really have for you. I can take more questions on it or anything, but I'll open it up for any questions you have for me in executive session.
So John, just for the AI thing.
Yeah.
So obviously you have cybersecurity, all that kind of stuff.
Yes.
And then, it's a good point with the AI to see where JEA is with that. And so, I think, because I'm not sure where the hell we are with that, how advanced it is or whatever, but point taken, thanks.
Yeah, definitely it is something you should look at. I mean, it's moving at a fast pace. I mean, we even, are utilizing it, not on your audit, but we use it for some of our other larger public company audits. And we're using, our client data in some cases in order to make our audit more effective and more efficient. So I know we've built in controls around the programs we're using. I don't know if your other business partners are doing that. So again, it's just making sure that you're comfortable from a board and from a committee perspective that your IT folks are on top of that. That's all. Because there is a lot of risk to the organization there, and not just financial, but operational, reputational risk, things like that.
Any other questions of John?
I've got a question. You mentioned in your presentation that from time to time you talk to the board about management succession. And
yes,
we've got an interim CEO. Do you have any advice or what we should be doing about how long do we go with that before we do a search or whatever?
Yeah, I chuckled because I've seen interims in place for like 3 years or more, which clearly isn't the 10th of an interim position. I think that's really more operational in nature, but what I would say is, whatever the board thinks appropriate. I mean, 6 months, 12 months, and at that point in time, reassess if you think the interim one wants to come on permanent, and if so, if they're meeting the expectations of the board. You probably want to do at least closer to 6 months because you know how long a search for a new CEO could take, right? I mean, that's a significant, important position for any organization, but especially here at JEA.
So Regina, I think, let's see, the current contract is April 16th, or so, about a year from when Vicki assumed interim duty. So I think that's a bookend for sure. We've got to do something no later than, and then lead time, so we don't run into busting that.
You're going to go out and have to do a search,
Okay.
unless, you're ready to conclude that you think she's the right person to
Sure.
be permanent, if that's something she even wants. I mean, I don't know, I haven't had those conversations with her. It's beyond my purview.
Mhm.
Yeah, well, thank you for bringing that up because that makes me wonder, do we have a 6-month sort of mile marker review planned or in place for Vicki to give her feedback on how she's performing against expectations in the interim role? And should we if not, should we look at building that out for her? Just from an employee perspective, I think it's just good to have that sort of dialogue and feedback.
Yeah, no, that's a great point, Kwanzaa. And and folks, correct me if I'm wrong, when I think our thought was start really getting into deep thinking on this once the external consultants were brought on, because part of their deep dive, in addition to capital projects and O&M, was also the organizational structure and senior level administration, et cetera. And I think and again, next board meeting, we select who that's going to be, and then we'll have a better idea what their timings are on it. But the idea is on that organizational structure, hopefully give us some insight into what we want for a permanent CEO too on it, in case there's other nuances we haven't thought of. So that said, and again, depending who we select, and they have different timelines for when they can give us a final product on that. Right now, it looks like it'd still be bumping pretty close up to like January, February, March timeframe, depending who we select for that feedback. So something we got to start thinking about now. Again, that pushes us almost point to really playing it close. Yeah. So I think
We can.
Go ahead,
Yeah, but Joe, we can extend Vicki if we feel like we need to until we're ready to make a decision. So I think it's worthwhile. hiring this group and making sure that, you know, we're working with this group. And if we have to extend this situation, but I think it's worth you having a deep dive, or whoever board members you think are necessary to have deep dive. Where is Vicky? Where's her thought process? But I think being stable for a while is important. You know, so that would be my recommendation.
Yeah, no, good input, Bobby, I agree. Any other comments?
Mr. Chair, I just wanted to clarify with the way the contract is currently drafted for the interim CEO. There are provisions to allow for extension because we did contemplate the business excellence consultant coming on. So there was time contemplated built in the event you had an issue with your consultant, the selection process of consultant, because there's a period of protest. If you have a issue getting that person on board, so it still allows for a continuity of having the interim serve. Once you were bringing the consultant on, if you were looking for recommendations from the consultant to help you select the qualities you're looking for in a CEO, there's time built in for that as well. So although you have the term, if you need to continue that term out a little bit further, there are provisions in the contract to allow for that.
Yeah, going back to the presentation that you made, you said there were a number of findings that were present before. Is that something that we should be concerned about?
Now, from a findings perspective, I thought I said, I don't know about before I came on,
Okay.
whether or not there were
Okay.
any findings. And this will be my 8th audit that I will be the partner in
Okay.
charge coming up. We have talked both to prior committees as well as management. The AICPA that promulgates auditing standards, they recommend for non-SEC reporting companies, partner rotation at 12 years. I've been on, this will be my 8th audit. I'm retiring in 2 years anyway. Our firm is in the process of already determining who my successor will be, and they're going to get a 2-year runway or lead time. I'll introduce that person to the committee, obviously, once we've identified
that's
that
great.
person. But yeah, my comment was before.
Got it. Okay, thank you for the
My
clarification.
understanding is that it's always been clean, but
Okay.
certainly the 7 years I've already done have been clean, no findings.
If we were clean in the last 7 years, we probably.
I should, within the realm of materiality from an external audit perspective, if there's $1 million fraud out there, we're not going to probably detect that just because it's not material. Yeah, under $1 million, we probably wouldn't detect that either.
Well, John, if there's no other questions, thank you for all you're doing, and yeah, everything you've done with JEA. It's comforting to know you're there, and working with you in the past has been great. So thank you.
Same here. Thank you. I appreciate the comments, and I do appreciate this committee, especially the openness that we've always had. I know we have some new members, and I'm looking forward to getting to know them a little bit better, and certainly working with them the next 2 years, this year and 2 more years before I retire. But obviously you have a direct line to me if you ever need to get a hold of me. And I mentioned also about doing inquiries around, fraud and propriety and things like that. I'll reach out individually to each of the committee members at the appropriate time, which will be closer to when we're wrapping up the audit, probably in that late November, early December timeframe. So you can expect me to be your assistant to be reaching out to set up some calls. But we'll definitely make sure we get those done. But obviously, we don't have to wait for that. If there's ever anything you need to talk to me about, I'm here to serve you guys, so reach out.
And for NG and Kwanzaa too, I mean, John, I've called him, there's no dumb question, and he's great, always available. So, yeah, he's very good and timely getting back if you have questions. So don't hold back.
Yep.
Regina, do you have anything else?
Nothing for me, Mr. Chair.
Then with that, the meeting is adjourned. Thank you guys so much for attending.
Thanks, Bobby. Great job.
Bye-bye.